Hello and welcome. It is currently 1:26 a.m. September 23rd, 2024, and today we're going to be looking at an outlook for the market for this upcoming week and how I'm internalizing the market to give some context behind any live streams today. So if you are watching this, you can compare notes with yourself, and if you're taking notes on ICT or you're just watching the mentorship live and taking notes later, you can compare your notes with that. So it's a pretty good resource. If I sound tired, I'm sorry, I am. So it's pretty late here. So starting with the monthly chart right here, you can see that the S&P, like we mentioned last week, I think it was, the S&P trades to the buy side liquidity. So the pink levels are the previous month high and the previous month low. So give me 1 second. So I have my notepad out here. So I have that level written down. And so on the weekly chart, as you can see, we have this week's high and low, and then we also have its TGIF retracement level. So as you can see, that the market on last week's trading, Friday's close was just at the 30% retracement of the week. So I think it's just a bit below, but that's just enough to maintain bullishness going into the next couple weeks. So you'll see when we drop down into a lower time frame how all of the price action from 57.55 and 3/4 to 57.28 and 2/4 is all balanced, and I'll show you that. But you can see how this wick fails to trade to the consequent encroachment from this candle's consequent encroachment. So this wick comes down and fails to trade to it, and then after it gives that signature, while NASDAQ is trading to that same wick's midpoint, the day after FOMC, we immediately start trading up higher and book this buy side. So the I guess the quote-unquote fundamental delivery of that was a 50 basis point cut, but I was just watching someone's Twitter space and overheard. Otherwise, I really don't look at that data. I don't really understand it, but I like to use it just because I like to keep it in mind in like the first hour or so of FOMC, just to gauge sentiment. So after seeing FOMC's price action last week and how the market failed to go any higher but was still respecting the daily discount arrays, when 6 p.m. opened the next day on Thursday, we saw that the 6 p.m. open, and after the market began to rally higher immediately, and from there we began to work higher on the daily chart. So Here's your daily chart with your new week opening gaps. Those are your TGIF levels. You can see that we have this high to work above, and then there's this buy side here which has already been booked, so it can use this as support once it gets above it. If we get to this buy side, you can see the 30% level. That's where the low of this current day has been booked. So Sunday going into Monday is what this candle is representing. And you see this wick right here. So those are the gradients. And you can see how on Friday the market delivered sell side going lower into this wick. So we mentioned how that this candle's wick is a balanced price range, so it could trade when price was here in the lower quadrant. We mentioned the consequent encroachment as inversion, so it traded into that, and now on Friday it failed to trade down into that. So that tells us that this little gap between the volume imbalance low and that candle's low is a gap left by the algorithm at a point where we would expect it to. And so the next most reasonable move for me, or I would say, is higher. So the exact level for that is 57.97 and 2/4. So that would be right here. So we'll call it 5,800 big figure. Now let's say it doesn't go there. We'll actually talk about that in the lower time frame. Daily chart, you can see from the consequent encroachment to the high how the market delivers into that, leaves a little portion open. I'd like to see that remaining open, and for the market to book higher going into this week. So that's my initial interest. Four-hour chart, you can see same buy side. It's now a relative equal high on a 4-hour cycle. So on this 4-hour candle at 10 a.m. we opened, came lower, went high, just retraced off the top. So power of 3 higher. We open here, trade to the consequent encroachment. I don't have the exact number on that, but that looks like the consequent encroachment. Power of 3. So accumulation, manipulation, and then they distribute down here into this wick, it looks like. So this to me is just a retracement lower if we're going higher. I like the wicks here on the volume imbalance. So this is a level that no one would really refer to other than ICT students. So it, the fact that it's giving these signatures here, I like that. The wick inside this wick. So a level that should be premium is now discount, and it's telling us that it doesn't even want to trade to the halfway point. So this candle, if you look at this, take the low, sell stops were swept here, and then we've traded higher since. So the next likely draw is 57.97 and 2/4, or 5,800 big figure. Friday's new day opening gap. Watch that price and how it books around it. So basically you're watching the up and down ebb and flow of price near this level until we book this level. Hourly, not an hourly, opening range gap, you can see we have this opening range gap, which is Thursday. And you can see, extend that out, on Friday we came down and traded into the opening range gap. Midpoint, so came down into that, delivered off of the volume imbalance high, and then closed for the week. So before we closed, it delivers into a weekly level and an opening range gap midpoint, which typically 70% of the times from 9:30 a.m. to 10 a.m. the opening range gap midpoint will fill in. That is 70% of the time. You can see over here, this is a 4-hour chart, but even in 4 hours, it did not fill that in. So comes back later the next day during what, after this level is booked, time distortion, time distortion, time distortion, time distortion, time distortion, time distortion from what? Yes, there's trades in here, but this is all time distortion to me from from the daily narrative. So this is pulling back on a daily chart to only go higher. So it's essentially distorting time. This is not progressive to the move higher, which is on the daily chart. So it's trying to book higher, I believe so. And it's going to continue giving off signatures like this, like this, like this gap, and the sweep of it. And this wick, we know that this occurred during FOMC, so there is lots of influence behind this candle. So that's my interest. So watching this candle, opening range gap, focus is on the buy side. So I've outlined the support, I've outlined draw on liquidity, and I've outlined why I believe it's going to go there. So 3 things. Alrighty, hourly close up. We have the September 19th, 2024 first presentation fair value gap. So that is formed on Friday. You can see we opened up around that level in here and traded up higher into that. So while it's too early to say what exactly or where exactly the high and low of day can be for me right now, I would prefer, and this is with a grain of salt, especially since it is only 1:21 a.m. I prefer to see or be present at the opening range gap. But for now, I like the consequent encroachment of this wick with this gap in confluence with that order block. So that's 3 PD raise. It can trade down into there, and then from there it can go higher. So it has all this space to create damage. This gap, you can see how we've spent from Friday, we've spent quite some time in that, but because it has this range here, it's possible for it to come as low as this gap right here. So we have 2 gaps, and we're allowing and being flexible for both of them. So until we have the opening bell, it's hard to say for me. So zoomed out, low, first low, high, lower low, break of structure. What is this? At one point, this was an up close candle. It's also a down close candle on a lower time frame. So it's a order block. It's a type of order block. Depends how you perceive it, in my opinion. But I like this as a breaker. So I would basically refer to this as a breaker because of the market structure. And if you pay attention, ICT has used wicks as breakers, and that's because the anatomy of it, if broken down in a fractal, it is essentially the same thing, and you'll see that on your own chart. But understanding what I'm saying here is it's hard, so it's not something you'll visualize in your head unless you know what I mean. And the only way you know what I mean is if you've backtested it yourself and preferably seen ICT's execution videos where he uses wicks for breakers. So I would use this wick as a breaker, and it does still meet the requirement of an up close candle. And additionally, it being the FOMC candle, I do like the, I guess, just the idea of this candle being used to send price higher from here. Dealing range, low, high. We're going to go down to a lower time frame. You can see how the market reacts at this equilibrium level, and it has traded at it for quite some time, creating highs and lows below and above that level. So this low, for example, this high, for example, and then we come back down, retrace, and then trade higher. So this is a displacement higher away from equilibrium. So that's why I was mentioning this gap in here and this order block right here. If we go back, over here I mentioned this order block. So if you take that, it was in confluence with this gap and this wick right here, that's this fractal, and you can see that's this candle's open. So extend that out, and then this candle too, and this one, extend those both out, and you'll find that that's in between this gap. So that's how I'm pairing levels for higher confluence when it does trade to it. That's it. Alright. And here's the NASDAQ, the monthly chart. So first thing first, previous month high is not traded to, so very good suspect or suspicion or reason to trade higher. So basically, another way to say this is S&P traded higher, NASDAQ has not yet traded higher. So in sympathy, the NASDAQ should follow higher, while S&P kind of outshines. Hopefully we see that this week, and if we do see that, then NASDAQ will follow pursuit, and the next objective would be that monthly high. And the reason this happens, in my opinion, what I've noticed is that because this is a monthly level, it's not a matter of fact of, oh, the Nasdaq is weaker or the S&P is weaker. Well, yes, it is weaker, the Nasdaq right now, because it hasn't traded to its previous month high. So that's like a reference point in time. But because it's such a monthly level, you can allow for about 5 days of variance for the level getting hit. So because S&P hit it, now we wait patiently and allow Nasdaq to do its job of following S&P, and S&P is leading this market right now. Gap higher from Friday's close to Sunday's open. Just gonna blast through this previous month high, relative equal high. Now would be a great time to trade up into that after retracing lower on Friday. The next best move is attack the money above here. Alright, that's what I think. This move caused damage. This move was a effect of this damage, but its next objective is higher. New week opening gap, you can see here. So all these should provide support until we reach here, but this is too far for me. So like I said, the money is here. This is the next draw. This is the first draw. You can't focus up here until you get here. It's not gonna gap, especially now. It's not gonna gap any higher. So basically, if you were to draw a line from here to here and extend it slowly, pip by pip, you would have to reach this level first. Like, before you reach this level first. And before that, you have this gap here, which could provide some resistance, depending on when we hit it and what the economic calendar looks like at that time. So focus is here. So here is that same wick that I spoke about on S&P. You can see how it trades into the upper quadrant of it beautifully, and then trades up, so kind of like a slingshot. And you can see that the Friday New Day opening gap is just above the open of Sunday, but you can see how now we're trading above it. So we'd want to see it come back down into it for support. My suspicion, and you'll see that on a lower time frame, once we get to that, I'll tell you whether I think it's likely to come back into there or not. So this candle's wick is the daily September 19th premium wick, consequent encroachment, so that level would be 20,133 flat. And you can see we've traded up into that. So now the real question is, after trading up into that, do we think that this is the high and it now comes lower? And longer term, do we think that this is the high and it's done? Like, do we think this sell side is next? Because I mean, if you just look at your chart on a daily, we either have these relative equal highs up here, or these relative equal lows, and I don't think it makes sense for this beautiful setup to pan out in price and not deliver higher this week. So here's a 4-hour chart. So study the opening range gap relative to S&P. And here's the hourly. So same gap. You can see how these levels like the order block and the wick are below the gap, but watch this gap. What I'll be watching is the low, the consequent encroachment, and the high. So that's what you should be watching too, considering that we are trading in it right now. This is a good sequence point to be watching, or a good PD array, especially if you like the gaps. You have a lot of probability behind this one. You have a lot of probability behind this gap because of this, and then on top of that, the same setup is on the S&P. Here's this same chart zoomed out. Remove the new day opening gaps. Try your dealing range. You can see that the equilibrium is much further from where we're trading at right now. So I do think that the NASDAQ can draw back into that before it trades here. So to answer the question from the daily chart, I think it was, not the 4-hour chart, do I think this level is likely to be traded to? Talking about the September 20th, 2024 opening range gap. Do I think so? Yes. I think it's likely that it can come back down and draw lower before trading up any higher. If we were to trade up any higher, I would actually prefer to see it trade lower, and then when it begins to trade higher, it should deliver every single signature you'd want to see in a buy program because of the higher time frame draw on liquidity. So here is the 15-minute chart. This whole entire gap can be traded into, like, it can melt into this as we enter the London session, and then this low is just, it's not relatively equal on the 15-minute, but it's too clean. And the way that this is, like, it looks like it's just about to drop in one candle, even in just this screenshot. The way that it looks like it's about to drop in one candle makes me think this low is the next attack to accumulate, essentially. So, and additional to that, we do have this gap inside this September 19th. That should not be the 20th. That should actually be 19th. So, excuse that. But that opening range gap, it can come back down into there. I'm allowing the flexibility for this to, once these levels are booked, I don't ask for too much precision until I'm in the moment. Like, I cannot give an exact level that it should stop dead in its tracks right here and then continue higher until it's actually in that moment, like, and trading there, and we are live and the market is ticking, and I'm watching the most recent candle, which would be like this, like how this screenshot is right now. I'm telling you, I like this low. But then we go right here on the daily chart, and I'm telling you I like this high. So the only way to understand this would be go to core content month 1, and until you understand that price goes lower before it goes higher, and it goes higher before it goes lower, it's not going to make sense. So that's it for NASDAQ. I wasn't planning on showing the dollar just because I wanted this to be shorter, but I'm just going to show you the screenshots, what I'm looking at. Monthly gap. I've been watching this since the beginning of the year. You can see it traded up into that and then trades lower, so that's risk on. Alright, so risk is on. Think about it like when price is going down, right? And this is just the way that I perceive it. It's not the actual technical way to think about it. This is like explaining it to a 2-year-old or like your dog. So if price is going down, imagine someone is buying this like stock over here, and it's going down right away as soon as they buy it. Risk is on, right? Because in their mind, it's just you've entered a riskier climate as soon as you're in drawdown. So that's how I like to think about it. If it's going lower, risk is on. If it's going higher, risk is off. So that means dollar higher, and it can spread its wings while all assets trade lower. But now this is going lower off of a monthly level, so this has a compound effect of any move that's going lower on this candle. So essentially what that means is the market, from a higher time frame perspective, is supposedly risk on, which would mean that, you know, dollar lower and markets higher, or not markets, assets higher, like indices or forex and currency and gold and anything else in that list. So why I think that's going to happen, just macro, like I guess it's because of the elections. So we could see elections bring these markets higher, get people in that euphoric feeling. I like the meme where it's like when you're in 100%, or I don't know if it's 100%, when you're in 20% drawdown or like 80% drawdown, and your trade, you know, goes up 5% or something, and like you're super excited. I think that's exactly how this economy is going to be. Is that we're in a terrible economy right now, and they're gonna try to make it as affordable as possible, or you know, pump out more money in the form of stocks, so people are gonna withdraw cash, and things are gonna be perceived as cheaper, but really all that's happening is people are just, you know, the mass crowd of everyone who puts their money into the markets, their money is growing faster, and it's keyword everyone. So no one really is getting richer. It's just you have a higher number in your account at the time, and there's a delayed effect for it to that, you know, that damage to be seen later, and that's essentially a bubble. And I think that bubble is going to burst sometime soon. It's just a matter of fact of when. I think after the elections is the most reasonable time to see it, especially with things that just they've been like spicing everything up. It's sus. That's the word I like to use. It's sus. Like when a kid says sus, it's sus. So anyways, let's continue with this. You can see every week we're just getting hammered lower and lower and lower, and any up close candles are just being met with more and more down close candles starting from here. So July going into December. If we just take July, for example, and draw a line here, and December would draw a line there. I do think that this thing can retrace higher, but I think right now the heaviness is just too much. I don't want to say where it can go, but I think it's heavy. Lots of new week opening gaps above the marketplace. I don't think that these are potential draws like this right now at the time. Like, I don't think your focus should be there. I think your focus should be inside this new week opening gap and this new week opening gap cluster, and you should be thinking that any new highs are suspect to me, and I can expect a 1 to 2, possibly 3-day variance in every time that dollar makes a high. How should I say this? Every time dollar is making a high, it's suspect. So it's going to be a short-term high and then continue trading lower, which is essentially going to make a nice, beautiful setup on S&P in, I would say, the latter portion of the week. So Monday going into Wednesday. That's what I like for S&P. That's what I like for dollar, and I showed you the NASDAQ. I would sum it up, but it's all in the video, so please go watch that. This wick, heavy. If it got above here, this wick's consequent encroachment, if it got above it, came back down, and treated it as a support, that's when I would, start looking at anything higher, like this new week opening gap, and this one. For now, just take this 101 200 and 101, we'll call it 200. So this low is our focus, by the way. That would be your focus, because these are relative equal lows, and if it's heavy, it's going to go lower. But it does have space to come up here into this new week opening gap. So it sounds 50-50, and I guess that's what we can call it for now. It's not possible for me right now at the point of my understanding and in time. It's not possible for me to tell you where this is going to go. There is times where it can, but it's just not right now. I think we might have some intraday back and forth price action on dollar, and expect some whiplash. Essentially, it will be like a consolidation is what I see setting up here, but that consolidation, as long as it's being met with highs that are being swept and trading lower, or just even failure highs, it's still heavy. So that is why I'm watching this new week opening gap and this new week opening gap. So I think that's the catalyst for the consolidation, and that's it. So nope, that 4 hour, that is it. So thank you for watching. It is very late. I think the chances that anyone is going to see this before it's, or after it's uploaded, I think markets will already be open by then. But I would have preferred to upload this earlier so you can see it a couple hours before you go to sleep, and then you can see it unfold tomorrow. But that's okay.